Welcome to the Daily Fortune, where we talk about the latest topics about finance and investment. But before that, please don't forget to click the like button, subscribe, and hit the notification bell so you'll know when we upload a new video. Now let's get started. Here's another video of Michael Burry's predictions. This time we'll focus on his predictions on housing bubbles. But what is a housing bubble? It's when the price of a house rises rapidly as a result of increased demand, limited availability, and emotional buying. Before we jump into the main topic, let's further discuss and explore its background for us to understand its whole concept. So let's start. Having a stable job, starting a business, building a family are all that we call the American dream. But owning a house has been on the top of the list and was everyone's classic idea of the American dream throughout the years. We all dreamt of having and owning a house, right? It's everybody's wish to have their dream house, whether buying a fully furnished house or building your own dream house. Whatever it is, it's very exciting to live comfortably inside your own home. In America, several banks have continued making new home loan products. This is to help Americans make their dreams come true. Actually, the administration has been fully supportive of providing the solution for every family in America. But there is a man who saw that there will be a lot of problems in the way. It's none other than Michael Burry. These huge obstacles were highly disregarded in the early 2000s, and it would finally destroy the housing market and the American economy. So there might be many questions that will boggle your mind, because I myself am curious as well. Like, how did Michael Burry predict this? Or who on earth could actually be right in most of what he thinks would happen? How did he bet against the US housing markets? How did he climb up to the top, even though his bet was opposing the American dream? Let us understand the fundamentals of the American house of cards, or also what others define as mortgage-backed security or mortgage bond. Let's make it simpler to easily understand this concept. For example, you want to buy a house that costs millions of dollars and would like to pay it in cash, or you want to take out a loan for millions of dollars. The bank will then give you how much you need or wanted. But don't forget that it's your full responsibility to pay your loan plus the interest rates for the next couple of years. And so if you're unable to pay or be consistent on your payments, that's when the bank will interfere and kill your dreams and happiness. They will take your house. Of course, this repetitive pattern encouraged banks to again process thousands of loans to offer those people who can't afford to buy a house. In reality, there are already a lot of us who have signed up for these 30-year mortgages, and they're repaying these loans plus our interest payments over the course of those 30 years. These days, what's also happening is that big investment banks will approach the small commercial banks and will tell them that they are going to write a check if small banks sell those mortgages to them. Then the small commercial banks will make a good deal. They'll demand for making a healthy profit in the process. In the end, small commercial banks will sell the mortgages to the bigger investment banks. So what's the meaning of this particular situation? All homeowners with mortgages are no longer making those payments and interests back to small commercial banks. It's all now going to the big investment bank that bought those mortgages. Here's the intriguing part. The big investment bank packages all of these mortgages into something called a special purpose entity or a special company. As a result, that corporation will receive a set amount of cash flow each year from all of us ordinary people simply paying off our mortgages. But there's more. Investment banks cut up the special company into a zillion tiny fragments. These small bits are the shares of the special purpose entities and investor who can purchase them. So if you invest in one of these special purpose entities, you're basically buying a piece of all the mortgages in that entity, which are slowly being repaid over time. The thing about mortgage-backed securities is that we're dealing with real individuals with real mortgages. And not everyone with a mortgage is gonna go on with the journey, right? Some might be early bird payers, while others may not be able to pay off their mortgage consistently and default on their loan, in which their home will be taken away from them. But the bank may only be able to recover 50% of the original loan amount. When you acquire mortgage-backed security, you're taking on that risk, so if you are a risk taker, get it. You, as the investor, must try to predict how many people will default on their mortgages, lowering your overall real return on investment. One thing to keep in mind regarding these special purpose entities is that the shares will be further divided into separate pieces or slices, which are referred to as tranches. There are 3 tranches: the senior tranche, mezzanine tranche, and equity tranche. Remember that this entire special purpose entity is just a giant collection of mortgages, and as we said before, some of those people are going to fail on their loans. Maybe not all of them, but some of them. From the 3 tranches, the equity tranche is the first in line. the first tranche of shares to take on defaults. After that, if there are enough defaults from this pool of mortgages to wipe out the equity tranche, the mezzanine tranche will begin to take on defaults. Finally, if there are enough defaults in this pool to wipe out the mezzanine tranche, the senior tranche will be affected. Because of this risk structure, the riskier equity tranche will initially provide a greater yield to investors, while the senior tranche will give the lowest yield to investors because it's the least risky. And this is the primary concept of a collateralized mortgage obligation. However, regardless of which tranche you purchase or whatever mortgage-backed security you invest in, you would expect that the bank only lends money to persons who are extremely likely to repay their loan. Let's continue with that thought. Mortgage securitization began in the 1970s, but it wasn't until President Ronald Reagan signed the Secondary Mortgage Market Enhancement Act in 1984 that things really started to get interesting. What this allowed for was pension funds and insurance companies to buy mortgage-backed securities. These securities were popular because of their promising yield but seemingly low risk, because at the end of the day, the securities were backed by mortgages. So that's all about the mortgage-backed security. And ultimately, what the securitization of mortgages meant for banks was that they could essentially write as many home loans as they wanted, because even if it was a small bank, they could bundle them together and sell them to an investment bank, which would then sell them to Wall Street. This fact, combined with the popularity of the American dream of owning a home, allowed banks to become creative, resulting in the creation of a slew of new mortgage products to assist more people in purchasing their own homes. Sounds great for those people. Now they get to live the American dream of owning a house. But it's also great for the banks because they're writing a lot more loans every quarter. It's a win-win situation for both parties. So what is Michael Burry saying with this? Burry discussed how mortgages have changed to help more people with their dream house. He said that in order to satisfy this dream, there's a needed tool. It's something that would make house loans considerably more accessible for people. Back in 1982, the Depository Institutions Act legalized adjustable rate mortgages for the first time. These adjustable rate mortgages, also known as teaser rate mortgages, would become the primary mortgage product at the heart of our economy's collapse 2.5 decades later in various forms. Adjustment mortgages, on the other hand, did not take off right away. They didn't truly take off until subsequent regulatory and legislative developments happened in the 1990s and early 2000s, kickstarting the market for mortgage affordability solutions. And it was in the early 2000s that Michael Burry first noticed this horrifying situation, since developing banks could basically lend money to anybody they wanted without checking the credit history. And the government was fully supportive because more people would have their own homes, which posed no risk to the banks because, they could simply grab this large pile of mortgage and sell it to Wall Street. What was becoming riskier were the mortgage-backed securities themselves, which were now being filled with the riskier and riskier loans, to the point that anyone could get a loan. Especially with interest rates in the United States decreasing from 6% to 1% from 2001 to 2003, borrowing money or taking home loans are no longer different because people are now getting loans. The downward trend of interest rates and teaser rates on adjustable rate loans means that it's natural for people to borrow more. An increase in housing prices is normal because everyone was purchasing. There wouldn't be a problem as long as house prices continued to rise and mortgage rates continued to fall. People might simply refinance their homes at the end of the day. After all, they would get a new loan to replace the previous one. And if they're lucky, they could get a better deal on the interest rate, but that would result in more debt. But guys, don't worry. Don't worry about your debt for a long time. And when you do, your house will probably be worth a lot more. So now we have banks that are offering loans to anyone. We have people who want to take those loans because it seems like it's basically free. And plus, if you don't get it now, you'll miss out on it. All of this, however, is dependent on housing values continuing to rise. And with the full backing of the US government, it was a positive feedback loop. Indeed, in 2003, there were early concerns that the housing market was inflating. Alan Greenspan, the head of the Federal Reserve, convinced everyone that national bubbles and the real estate simply do not happen. He pondered whether common sense ought to rule against the application of precedent to unprecedented as he served and examined national trends in housing at the time. So how did Michael Burry figure out this would not be a happy ending? According to him, the introduction of the interest-only adjustable rate mortgage in 2003 stabilized mortgage rates, and banks chose to take the risk and offer interest-only adjustable rate mortgages in which the borrower delays any principal payments for a period of time to assist promoting additional loans and drive the economy. The cost of housing is increasing lenders by launching a mortgage product that they had been avoiding for a long time. They demonstrated for all to see that they were more concerned with growth than with maintaining credit standards. They weren't interested in checking for excessive credit risk at the doors. By fall of 2004, he had informed his investors that Nationwide Financial, a prominent national mortgage lender, had reported a 158% increase in subprime mortgage originations year over year. Despite a 24% drop in overall loan originations, evidence was visible. Banks were chasing bad credits, inclusive of housing speculators. Burry is fully aware of the situation, on what will happen, and he theorized that the market's peak would be a point at which non-credit-worthy applicants would be able to obtain a home loan with a monthly repayment that was affordable. Remember that all of these shady mortgages were just being stacked up and sold onto Wall Street at the time, and they were being made into mortgage-backed securities, which was a huge advantage for Michael Burry because they were being made into securities. They had to file mandatory and regulatory filings with the SEC, which meant that all of this information was public, and Michael Burry could go read about it. And that's exactly what he did, and how he discovered the true scope of the problem. Even when Michael Burry thought things couldn't get any worse, they did. Banks began issuing a new form of loan for the worst of the worst. It was an interest-only subprime adjustable-rate mortgage with a negative amortization schedule. In simple terms, it implies that subprime borrowers were allowed to take out large loans for which they didn't even have to make a monthly payment. Instead, they could choose to pay nothing, and the amount they should have paid that month would be added to the principal of the loan. What kind of borrower do you think would be interested in such a loan, right? A big disadvantage on the side of the borrower is that they will gain no income at all. He recognized now that this was a mortgage product, and the only way it wouldn't go bad was if house prices continued to rise. He himself stated that this form of the product would not exist unless house price appreciation was the primary assumption, and that home price appreciation was doomed to fail precisely because these mortgage products existed. I saw absolutely no chance of home prices going sideways or stabilizing for any significant length of time. Once home price appreciation was no longer a given, these new types of mortgages would simply disappear. Home prices starved of peak credit would fall and fall steeply as mortgage and refinancing options crumbled away. The crisis, in my view, would start in 2007, by which time teaser rate periods on the vast majority of these new types of mortgages would expire or reset for a population of homeowners trapped in mortgages they could no longer afford. And on the way down, housing would take consumer spending, jobs, and everything with it. A positive feedback loop of a very damaging variety was set up. From Burry's statement here, what do you think he did next? The genius investor effectively shorted the housing market with what we call a credit default swap. Specifically, I set out to buy credit default swaps on subordinated tranches of subprime residential mortgage-backed securities, Burry added. There's a lot to reveal here, so let's start with what he purchased. A credit default swap. This is a contract that Michael Burry would have purchased from another investor. The buyer of the swap would make payments to the swap's seller until the contract's maturity date, in exchange for the seller agreeing to pay Burry the security's value, as well as all interest payments that would have been paid between that time and the security's maturity date if the subordinated tranches of the mortgage-backed security failed. To have a clear idea of what I'm talking about, here's the thing. If the housing market collapsed, which it did, house prices would fall. People could no longer refinance, and that will make the homeowner's debt catch up with them, defaulting. The rates are increasing because the price of their homes are worth less than their debts. That was a major problem because those people who reclaimed the houses that were sold didn't recover at least near the original loan amount. This debacle damaged mortgage-backed securities, which were at the foundation of the American financial system, as a result of obtaining insurance on an asset he didn't even own. Michael Burry profited himself by $100 million, and his investors profited by $700 million. Between its beginning on November 1st of 2000 and June 2008, Scion Capital generated returns of 489.34%. In that same time frame, the S&P 500 returned under 3%. Overall, Michael Burry foresaw the impending collapse of the American economy and basically profited from it. So that's it for today. I hope you learned something from today's video, and to get updated with the next videos, don't forget to hit the notification bell. See you next time.